In this free video course, I'm going to show you the basics of supply and demand trading in a simple and straightforward way. Supply and demand trading is perhaps one of the most powerful trading techniques because it's directly built on one of the most important ideas found in economics, which is the law of supply and demand. This law is what regulates the behavior of buyers and sellers, not just in the financial markets, but in all markets you can imagine. So it's obviously in every trader's interest to learn how supply and demand works in the context of technical analysis and price action reading. Before we begin the video, I would like to politely ask that if you are new to the channel, you hit the like button and subscribe. It's only a small gesture on your part, but it makes a tremendous difference for the channel. I guarantee you will not be disappointed. In this video, you will learn how the law of supply and demand works, how it controls all markets, how, why, and when prices rise or fall, what happens with supply and demand when price reverses direction, and how to use the supply and demand technique in trading. So without further ado, let's begin talking about the supply and demand technique. There are two sides of the supply and demand technique when it comes to price action trading. We first must apprehend how the law of supply and demand works, which is an idea from economics, and then we must align this idea with the basic premise of technical analysis and price action reading, which is that we can use the recent past of price to understand its near future. Without these two elements combined together, it's impossible to use the supply and demand technique effectively. There is no question about the validity of the law of supply and demand, as it is widely used by economists to analyze all sorts of situations that happen in the economy. However, there is some debate about the basic premise of technical analysis and price action reading, as we'll see later in the course. We'll first strip down the law of supply and demand to understand how the idea of market equilibrium works, and then we'll combine that with the basic premise of technical analysis and price action so we can use the concept of supply and demand to speculate about the near future of price in light of the recent past. We'll also observe examples of this technique working and failing in real price charts so you can have a good idea of what to expect when you study charts yourself. Just as a reminder, this video is made for educational purposes only, like all the other videos in the channel and the courses I provide. Use these techniques at your own risk. Before learning what the law of supply and demand is, we must first apprehend the law of demand and the law of supply individually. And even before that, we must apprehend that demand relates to buyers and supply relates to sellers. That's because buyers demand or seek for products, services, or financial assets. Sellers provide or supply products, services, or financial assets. In summary, when we talk about demand, we are talking about buyers, and when we talk about supply, we are talking about sellers. The law of demand claims that the higher the price of something, the less buyers will demand it. That makes perfect sense even for people who don't know what the law of demand is. The higher the price of something, the less willing you are to buy it because you want to spend the least amount of money possible for obvious reasons. You don't want to pay more than what you really need to in order to get something. This is precisely why more expensive items are sold in lower quantity. They have a much higher price, so there is a lot less people willing to buy them. There are other factors at play here, of course, but the law of demand is a big part of the explanation. Using the jargon found in economics, the law of demand states that the higher the price, the lower the quantity demanded of an item. We can visualize the law of demand using a simple graph. In the x-axis, we have the quantity demanded, and in the y-axis, we have the price of an item. The higher the price, the lower the quantity demanded, so that the demand curve is a downsloping line. The law of supply, on the other hand, states that the higher the price of something, the more sellers will be willing to sell it. This is also an obvious thing even for those who are not aware of the law of supply. The higher the price of something, the more money you can make by selling it. Using the jargon found in economics, the law of supply claims that the higher the price, the higher the quantity supplied of an item. We can visualize the law of supply using a simple graph. In the x-axis, we have the quantity supplied, and in the y-axis, we have the price of an item. The higher the price, the higher the quantity supplied, so the supply curve is an upsloping line. Given these two separate definitions, we must now combine them to understand the law of supply and demand and the notion of market equilibrium, The law of supply and demand states that price will always seek the market equilibrium, which is the point where the supply and demand curves cross each other. In other words, when the quantity that all buyers want to buy is equal to the quantity that all sellers want to sell, the price of this market will be at equilibrium, meaning that it doesn't change because there is no motivation to do so. When the supply and demand curves move, the point of equilibrium will change, and then price will seek this new equilibrium naturally. We can once again visualize that by plotting the supply curve and the demand curve on the same graph. Rather intuitively, the market equilibrium occurs at the point where the supply and demand curves cross each other. This is the quantity that will satisfy both buyers and sellers in the market at that price. In other words, when the market is in equilibrium, prices don't change because buyers don't have the motivation to buy more or buy less, and sellers don't have the motivation to sell more or sell less. All market participants are satisfied in a way. Another very important notion is that any market will always seek the equilibrium naturally. This is what Adam Smith called the invisible hand of the market. In other words, any market has a self-correcting mechanism that automatically adjusts the price of whatever is being traded according to the free will and self-interest of buyers and sellers. This is of course a reflection of human nature and not a consequence of some arbitrary rule. In other words, when you let people trade freely according to their self-interest, a market economy and the law of supply and demand emerge naturally. This point where the supply and demand curves cross each other is called point of equilibrium, and at this point, price remains constant because buyers and sellers don't have motivation to buy or sell less or more. However, you must have noticed by now that price is hardly ever at an equilibrium, meaning that it's constantly changing in the financial markets. So you might be asking yourself what causes prices to change. The answer to this question is something called supply and demand shifts. The number of buyers and sellers and their willingness to buy or sell something is constantly changing. In the financial markets, buyers and sellers are always speculating about whether or not a market is undervalued or overvalued. There are literally hundreds of variables that affect that judgment. When buyers or sellers change their perception about a market, that perception shifts the supply and demand curves, so the market will seek a new equilibrium. Here it's also useful to understand the difference between price and value. Price is just a number that you see on the screen, which is the current result of a market trying to seek its equilibrium. The value is how buyers and sellers perceive price. This perception of value is what causes supply and demand shifts and makes price move up or down in the end. The perception of value about a market changes first, and then the market seeks the new equilibrium, making price reflect the new information. For example, if for some reason the buyers in a market start to believe that such a market is undervalued or cheap, the demand in that market will increase, meaning that buyers will be willing to buy more of the same thing at a given price, and that causes the demand curve to move to the right. Automatically, a shift to the right in the demand curve will cause the new market equilibrium to be at a higher price because the point of equilibrium, which is the point where supply and demand curves cross each other, will suffer a movement up the supply curve. Remember that sellers want to sell at the highest price possible, so if buyers are willing to buy more at the same price, sellers will increase price to adjust the new demand to the current supply. This is an example of a demand shift that causes price to rise. In the same way, if for whatever reason sellers become more willing to sell in a particular market, therefore causing the supply curve to move to the right, price will go down as a result of the point of equilibrium suffering a movement down the demand curve. This is the underlying mechanism in all markets you can imagine, not just in the financial markets. It is the basis of a market economy. In these two examples, we saw an increase in demand and an increase in supply. But of course, there can be a decrease in demand and a decrease in supply as well. The main point is that by visualizing the supply and demand curves, we can understand why supply and demand shifts motivate buyers and sellers to produce movement along the curves, ultimately altering the market price. This concludes the first part of the course, where we dive a little deeper into the idea of supply and demand. Now we need to align what we learned with the basic premise of technical analysis and price action reading. This premise states that we can use the recent past of price to understand or predict what's going to happen in the near future of price. Another way of looking at this is that we can find repeatable and therefore exploitable patterns in price. Without this premise, anything about technical analysis and price action falls apart. So if we want to continue, we need to assume this is true, which it is, but you have to be careful here. I say that because even though this is true, it's not true all the time. It's true only when there are not other stronger forces acting on price. For example, technical analysis and price action techniques and methods tend to work when the market is in a certain state of normality. When there are dramatic events affecting the market like major news or major macroeconomic forces, technical analysis and price action reading tend to be distorted or they tend to become unreliable. This is why sometimes we will do everything right in terms of technique and your trades will still fail. However, that's a subject for another video or perhaps another course. For the purposes of this course, you should understand that price reverses direction when there is a dramatic change in supply or demand. Another way of thinking about this is that the greater the shift in the supply and demand curves, the greater the response in price. Obviously, we cannot see the supply and demand curves of a market, so we need to perform an analysis to infer what's happening with the curves. For that, we need to align the law of supply and demand with the basic premise of technical analysis and price action reading, which is that past price information can be used to project future market direction, meaning that we can forecast the near future using the recent past. All of that is based on the idea that the market has some sort of memory and it reacts to past events in a predictable way. That means that there are places in the chart that we can identify supply and demand changes that might be able to help us in the future. The premise of using supply and demand in price charts is that the market will somehow remember the last supply and demand changes, and it will react to these levels in the same way it did in the past if price comes back to it. Let's take a look at the demand zone example first. In this illustration, you can see price going up. The low that is formed between two highs is where the demand zone will be. In other words, a demand zone will be near a low. By extending this zone into the future and counting on the basic premise of price action, we can count on the fact that if price comes back there, the same buyers that made price rise the last time will do it again. The low out of which the demand zone comes is a place where the demand curve has suffered a tremendous shift to the right, so now the market will seek the new equilibrium by producing a movement up the supply curve. That's what makes price go up. Another important point here is that supply and demand zones are stronger when the movement right after the zone produces a confirmation about the intent of the market player that produced the zone in the first place. For example, in this illustration, we can see that after the demand zone, buyers were able to create a higher high, and that means these buyers still have enough momentum to be trusted in the future. If these buyers were not able to create the higher high, it would be more dangerous to trust their demand zone in the future because of a lack of bullish momentum. Let's summarize a few guidelines about the demand zone. The low between two highs is where a significant demand shift happened. The market will seek a new equilibrium by producing a movement up the supply curve. Price will rise as a result of this movement up the supply curve. The demand zone will form in the low between two highs. The second high must be higher than the first one for the demand zone to be strong. We can extend this zone horizontally to project the next possible significant low. Let's now look at the supply zone example. In this illustration, you can see price going down. The high that is formed between two lows is where the supply zone will be. In other words, a supply zone will be near a high. By extending this zone into the future and counting on the basic premise of price action, we can count on the fact that if price comes back there, the same sellers that made price fall the last time will do it again. The high out of which the supply zone comes is a place where the supply curve has suffered a tremendous shift to the right. So now the market will seek the new equilibrium by producing a movement down the demand curve. That's what makes price go down. Another important point here is that supply and demand zones are stronger when the movement right after the zone produces a confirmation about the intent of the market player that produced the zone in the first place. For example, in this illustration, we can see that after the supply zone, sellers were able to create a lower low. That means these sellers still have enough momentum to be trusted in the future. If these sellers were not able to create the lower low, it would be more dangerous to trust their supply zone in the future because of a lack of bearish momentum. Let's summarize a few guidelines about the supply zone. The high between two lows is where a significant supply shift happened. The market will seek a new equilibrium by producing a movement down the demand curve. Price will fall as a result of this movement down the demand curve. A supply zone will form in the high between the two lows. The second low must be lower than the first one for the supply zone to be strong. We can extend this zone horizontally to project the next possible significant high. In summary, we know that a demand zone happens in the low between two highs where the second high is higher than the first one, and a supply zone happens in the high between two lows where the second low is lower than the first one. Knowing where zones are roughly located is one thing. Knowing exactly how to draw them is another. So next we are going to establish some rules and guidelines to draw the supply and demand zones. Since we are talking about a zone, we need to establish two lines since a zone is formed by the space between these two lines. One of these lines is easier to establish, and the other depends on each market scenario, unfortunately. Let's begin first with the demand zone. In a demand zone, the easier line to draw is the lower one. All you need to do to be safe while drawing this line is following the absolute low in between the two highs in question. In theory, the next possible significant low can retrace all the way down to this low out of which the zone comes. The difficult line to draw in a demand zone is the upper one because it depends on each individual market situation. The rule for this upper line is that you need to identify a level where buyers really decided to bring price up, but it needs to be a different level than the absolute low, since that's already being used for the lower line of the zone. We'll observe some examples of this in just a moment. In a supply zone, the easier line to draw is the upper one. All you need to do to be safe while drawing this line is following the absolute high in between the two lows in question. In theory, the next possible significant high can retrace all the way up to this high out of which the zone comes. The difficult line to draw in a supply zone is the lower one because it depends on each individual market situation. The rule for this lower line is that you need to identify a level where sellers really decided to bring price down, but it needs to be a different level than the absolute high, since that's already being used for the upper line of the zone. Basically, you need to identify the absolute market extreme and a level that highlights an important decision from the market players. Before we move on to the examples using real price charts, let's quickly go through another important aspect of supply and demand zones, which is the risk management property built in this technique. By definition, a supply or demand zone will provide a logical place to put a stop-loss order that is near the entry point. That implies that we have a small and logical stop-loss order that has the protection of the market player in question, with a good headroom for the take-profit target. In summary, supply or demand zones provide a small and logical stop-loss with a large potential take-profit target, which is an absolute necessity if you want to survive trading in the long term. In other words, using a risk-reward ratio of 1-to-3 or 1-to-4 with supply and demand zones will make sure you can make money even if you are wrong more than 50% of the time, because it will take a few losses to wipe out one profitable trade. If you use a 1-to-3 risk-reward ratio, you can lose 75% of the time and still break even. If you use a 1-to-4 risk-reward ratio, you can lose a whopping 80% of the time and still break even. All of that, of course, assumes that your stop loss and risk is the same in all trades. Trading is not about achieving the highest win rate possible. It's about having enough room to make mistakes and still make money. Let's now move on to practical examples, as it will become much clearer what supply and demand zones are all about. I should tell you first that supply and demand zones work in all time frames and in all markets, so you don't have to worry about that. As I said before, the mechanism of supply and demand is something that underlies all markets. In this first example, we'll analyze a demand zone. Notice that we have two highs where the second is higher than the first, so the low in between is where the demand zone is. As I said before, finding the lower line of the demand zone is simpler since you can always go to the lowest point of the low in between the two highs. The more difficult part of the demand zone is finding out where the upper line of the zone is. To find this line, we must ask ourselves where did the buyers really decide to bring the market up after the lowest point of the low in between the two highs. If you look carefully, there's an increase in volatility right after the lowest point. This increase in volatility is highlighted by a larger bullish candlestick. The point of origin of this candlestick, meaning its opening value, is where the buyers from this demand zone really decided to bring the market up. So in this case, we can assign the upper line of our demand zone to the opening of this candlestick. If price retraces back to the demand zone, we have an opportunity to go long in this market with a stop below the low in between the two highs and a target that is 3 to 4 times as large as the stop as we discussed earlier. So let's fast forward price to observe the changes in price action. In this very candle, we can see evidence of our demand zone working properly. Notice that as soon as price touches the demand zone, it immediately reacts to it by creating a large lower tail or lower shadow in the respective candlestick. That is a sign of buying pressure, which makes sense in prices entering a demand zone. By the way, if you want to learn more about candlestick patterns and their interpretation, don't forget to check my free candlestick patterns course in the YouTube card. As soon as you see the evidence that buyers are still hanging around the level of the demand zone, you can think about an entry. There are hundreds of different ways to enter in the market, so we cannot explore them all in this video alone. But here's one advantage of using supply and demand zones. Since we are pretty close to the logical stop loss level, you can enter the trade in the very next candle. That's not always the case, but in the situation that we are analyzing right now, it seems okay. Don't forget that the more precise you get in your entries, the less risk you're going to take, and the higher your risk reward will be, which means you will increase your margin of error dramatically. That will propel you forwards into long-term sustainability. By fasting forward price, we can see that the market would meander a little bit, and then it would start to go up using the demand zone as a cushion, and after that, hitting the appropriate target. The next example we are going to study is from a supply zone. This might be a little trickier because it will involve other highs and lows in the middle, but if you adhere to the rules I already established, it should be easy to filter out the noise and concentrate on the details that really matter. The first thing to notice here is that we have two lows highlighted. The second low is lower than the first one, so a supply zone will come out of the high in the middle of these lows. Now we need to move on to the upper and lower limits of the supply zone. In the case of a supply zone, the upper boundary is easier to draw because we can simply count on the highest point of the high in the middle of the two lows we highlighted before. The difficult part about a supply zone is determining its lower limit or lower boundary. That's because we need to find a place after the high where sellers really decided to bring the market down. Needless to say, this will vary a lot depending on the market scenario you are analyzing. That's why it's difficult to come up with one single rule that works every single time for all cases. This example is actually similar to the previous example where we examined a demand zone. Right after the high, we can see that there is an explosion of volatility to the downside. This is where sellers really decided to bring the market down, so we can use this as the lower boundary of our supply zone. There are other more advanced techniques that will point to different levels that can be used here, but I'm not going to go into detail about those since this is a beginner's guide. I'm just showing you the basics in here. The supply zone represents a range of price where strong sellers are likely to be at. If price returns to this level, there might be grounds for a short trade depending on what price does if it reaches the zone. Let's advance price to see what happens. At this point, we can identify a few different things in here. In the micro level, we can see that candlesticks pierce the lower boundary of our supply zone, and judging by the pronounced upper tail in this candlestick, we can see that there is some selling pressure in the zone still. So far, this is great evidence for a short trade in here since the current price action agrees with the supply zone. In a broader sense, however, the situation might not be so clear. Observe that by the time price retraces to the supply zone, buyers just got a new demand zone proven. That is of course evidence for bullish strength. I want to point this out to you because there will be many times where you will find yourself in a situation like this, and then you will have to make a judgment call based on which market player is stronger and which one has more room to travel at the moment. This is also a more advanced subject, but I thought it would be a good idea to point it out to you. Despite all of that, we are at a supply zone with a very good stop loss level above the highest high in the chart, and plenty of room for price to travel enough to yield at least a 1 to 3 risk-reward ratio. If price goes back down there, the target will be more or less where the newly created demand zone is. So let's advance price to observe what happens. We can clearly see here that sellers indeed show up again and supported the short trade. These two examples highlight how supply and demand zones work in optimal scenarios. However, in real life, things are not so pretty. Because of that, I decided to show you a couple of more examples of what happens when supply and demand zones fail. Perhaps more importantly than knowing what to do when this technique works, is knowing what to do when it doesn't work. It's not difficult to find examples of failed supply and demand zones. We don't even have to change the chart for that. Let's use the example of the demand zone we identified in the previous example. We have the low in between two highs where the second high is higher than the first one, so at least in theory, we are dealing with a strong demand zone. To draw the lower boundary of the demand zone, we can simply go to the lowest point of the low in between the two highs. And once again, the upper boundary can be determined by the shift in volatility that happens right after the low. Let me remind you once again that this is not always the case. There are many more examples of market scenarios where it's really difficult to pinpoint one of the boundaries of the zone. We can already see that this demand zone clearly failed, but there are clues you can spot to help you identify that in real time. The most important thing you can do is to watch what price does as it reaches the zone. Notice that in this case, price simply ignored the existence of the demand zone. As price touches the upper and lower boundaries of the zone, there is no evidence of bullish pressure of any kind. On the contrary, there is only evidence of bearish pressure. It is as if the demand zone wasn't even there in the first place. However, even if you ignore this fact and you took a long trade there, the stop loss would still be pretty small and the damage would not be so big. This is once again one of the great things about the supply and demand zone technique. It gives you a logical and small stop loss order placement. Notice that if you took the previous short trade in the example about the supply zone, and you also took the long trade, your total P&L would be positive because the target of your trades are a few times larger than the risk. So it takes a few bad trades to wipe out the profit from one good trade. Let's now look at one last example where a supply zone fails. At this point, you should be identifying the basic elements of a supply zone more quickly. We can see the two lows where the second is lower than the first, and we can see the upper boundary of the zone marked by the absolute high and the lower boundary of the zone highlighted by the increase in volatility to the downside after the absolute high. It's interesting to notice how price comes back to the level where volatility increased and starts to go down again from that point. It's an indication that this is indeed a good place to put the lower boundary of the supply zone. Let's advance price to see what happens. At this point, you can look at this and think that price is touching the lower boundary of the supply zone and showing a little bit of selling pressure by the way the upper tail or upper shadow of that candlestick looks. For all intents and purposes, that is a correct assumption, so you could in theory go ahead and place a short trade with a stop above the high that originated the supply zone in the first place, with a target that is 3 or 4 times as large as we have been discussing throughout the course. Let's advance price to see what happens. Here we can see that, despite this being a perfectly valid trade, it would have been stopped out. At this point, you will start asking yourself what you did wrong, and you can also start to rationalize why you shouldn't take this trade. This is a slippery slope, and I want to grab your attention to why this sort of thing happens. Traders need to understand that technical analysis and price action analysis are not exact sciences. There are many different types of market participants acting for different reasons. That means that there is no such thing as a technique that works all the time. And as I just said, sometimes you will do everything correctly and the trade will still fail. If that wasn't the case, we would not be talking about speculation anymore. No matter how good your technique is, in trading you are always speculating and taking a chance at the end. The way we have to counteract this uncertainty of trading is by using good risk management guidelines. This is precisely the reason why you need to use a risk-reward ratio that allows you to be wrong most of the time and still make money in the end. In the long term, your profits will be bigger than your losses and you will make money. So sometimes you will be let down by a trade that looked promising and ended up failing, and others you will beat yourself up because you didn't take the trade that looked sketchy and it ended up working. That's natural in trading. To sum things up, the supply and demand technique is one of the most reliable trading techniques for two main reasons. First, it's a technique based on an actual principle of economics that happens to be widely used and respected across multiple schools of economic thought. The second reason is that the supply and demand technique has no lag, unlike many of the trading techniques you see out there. It's definitely a good tool to have under your belt as a trader. This concludes this free video course about supply and demand technique. If you like the course and you wish that I continue to create quality educational content for free, please consider hitting the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your comment below. If you want to take your trading to the next level and learn many more techniques, strategies, and methodologies, please visit my official website fractalflowpro.com in the YouTube card or in the link available in the video description, and check out my paid courses as well. That's it for this video. I really hope you learned something new and useful. So thank you very much for watching, and I hope to see you in the next videos. Take care.